Warren Buffett earlier this month released what he's been buying and what he's been selling in the fourth quarter of 2024. And there's some new things he's been buying, and there's some surprises with what he's been selling as well. And so we're going to be covering what's been happening in Warren Buffett's portfolio as well as some other super investors' portfolio and what we can learn from this. And also be sure to stay until the end because we're going to save some of the best here for last, and we'll get right into it. A lot of times people like to follow what Buffett's been buying and what he's been selling to get a good idea for what they may also want to buy and sell. It's good to follow some of these value managers because a lot of times what they're buying and what they're selling, you can actually buy at better prices than they're buying, and when they start selling, you could possibly sell at prices higher than when they've been selling. And so when we look at how Buffett's done over time, just from Berkshire Hathaway shares, you can see that starting in 1964 through around 2018, $19 invested in Berkshire Hathaway grew to about $290,000. So that's a pretty good return, I'd say. But that pales in comparison to the returns in the Buffett partnership, which he ran from the late 50s through to 1968, where he returned around 31% over that period of time. So 31% is a pretty good return, which blew out the S&P 500 and the Dow during that period of time. So Buffett, going back a long period of time, has done extremely well. In recent years, if we look at the period from just before the great financial crisis until now, we can see that Buffett has done not as well as the S&P 500. Growth investments have done much better than value investments over this period of time. But if we zoom out, it looks a little bit different. When we zoom out going back to 2000, just before the dot-com crash, you can see that Buffett has done so much better than the S&P 500 and the Dow. What we're dealing with right now is very similar to the dot-com boom, except now we're getting an AI boom, and there's a lot of money chasing the biggest, most popular companies. Obviously, Warren Buffett isn't going to invest in the biggest, most popular companies, except for Apple, where he's been paring back on that. Buffett is more likely to outperform when the market comes down and there's rough waters. When things are falling apart, Buffett's more likely to protect investors on the downside. And that's the way most value investors are. They protect investors on the downside. So when we look at some of the super investors that Warren Buffett talked about in his 1984 speech at Columbia University, he talked about Bill Ruane, who ran the Sequoia Fund, and he referred all of his partnership people to Bill Ruane at the Sequoia Fund when he shut it down around 1970. He ran Berkshire Hathaway with Charlie Munger for many years, and Rick Warren was a partner for a little bit of that time. Actually, Charlie Munger and Rick Warren ran the Daily Journal together. Tom Knapp is another one that was involved, I think, in Tweety Brown. Walter Schloss was one that he mentions in the super investors of Graham and Doddville. And all of these people have done significantly better than the Dow and the S&P over time. When we look at the Sequoia Fund, if you invested in the Sequoia Fund at the beginning of the 70s, you lagged the market for about 3 or 4 years, but those who stuck with it did extremely well. So value investing may not work well for periods of time, but those who stuck with these investors, those who have stuck with Warren Buffett over time have done extremely well. Those who stuck with the Sequoia Fund in the 1970s going into the 1980s did extremely well because they didn't abandon their philosophy of investing in well-known, undervalued companies. And of course, with Sequoia Fund, they may have been buying less well-known, undervalued companies. When we look at some of these super investors, especially value investors, they tend to eat their own cooking. They're invested in the same holdings that their investors invest in. When we look at the best managers, they invest in the same thing. They invest in their own fund. They invest in a lot of the same holdings. They're proven to protect in down markets. They're more interested in buying at a good value, and buying in good value tends to not go down as much as the things that are overvalued in down markets. They tend to buy and sell less than a lot of other investors, and they have the right temperament. Warren Buffett likes to say that he gets greedy when others are fearful and fearful when others are greedy. A lot of these investors want to commit to a lot of their best holdings. If you own hundreds of things, you're not likely to do near as well as if you commit the most capital to the things you're most excited about and have the most conviction about. And of course, these value investors and these super investors have a disciplined strategy that they stick to through thick and thin. It may not work all the time, but it works most of the time, especially in down markets. And we want to stick with this strategy. 1 year does not make it for these investors. If you bail after 1 year, a lot of times you'll miss out on all the good years. Even bailing after 3 or 4 years, like with Sequoia in the early 70s, you missed out on all the good years from the ensuing decade. So if you bail out, you're likely to miss out on all the upside. We can look at how other investors have done over time. Some of these investors like Joel Greenblatt and Stanley Druckenmiller and David Tepper have done extremely well over time, but Warren Buffett has the longest track record with the longest history of outperformance over a 50-plus year period. A lot of these super investors have been gearing up more toward consumer discretionary names. They've taken a cautious approach toward financial companies, and they've leaned more into buying value. These super investors are also diversifying across sectors, and they're reducing their tech exposure. For a lot of companies in the tech space, we can see that tech has become a bigger component of the S&P 500 than even it was in the late 1990s and early 2000s. And so that is giving a lot of people a little bit of concern. And so a lot of these super investors are reducing their tech exposure. But what has Warren Buffett done? In the past quarter, he's been buying up a few companies, but mostly been selling. He's been selling around $14 billion worth of shares. He's freed up a good bit of cash, but he's only bought about $3.5 billion worth of companies, including some that he's been buying a little bit over time. We're assuming that Berkshire Hathaway now has around $340 billion to $350 billion in cash. And that's assuming he hasn't bought anything else other than what he's already disclosed. One of the new things that he's been buying is Constellation Brands. And Constellation Brands is an alcoholic beverage producer. The price for Constellation Brands came down quite a bit in the fourth quarter. And Warren Buffett bought up around $1.2 billion worth of Constellation Brands. But Constellation Brands has continued to go down. It went down an additional 30%. When it was announced, it jumped up about 7%. But Constellation Brands still looks like a good buy here. If you want to follow in Warren Buffett's footsteps, you can actually buy this company for less than Warren Buffett bought it in the fourth quarter. Warren Buffett still has a taste for Domino's Pizza also. He was buying this earlier in the year, continued buying in the fourth quarter, and the price came down a little bit lower in January. It's gone up a good bit since then, but there may be a chance to be buying Domino's Pizza potentially for less than what Warren Buffett bought it for in the fourth quarter. SiriusXM continues to be something that Buffett is buying. He has been buying at prices above $30, so we can still get it at a good price. Occidental Petroleum continues to be something that Buffett likes. It may be that Warren Buffett intends to buy the entire company eventually. If he does that, he'll buy it at a premium, and we can now buy it at prices less than Buffett bought it throughout 2024. VeriSign is something that Buffett likes because it has monopoly power. It has a wide moat, as he likes to talk about. They control all the domains for .com and .net websites. And so with VeriSign, we can get VeriSign at a good price right now. Maybe not quite as good as we could in the fourth quarter, but still a pretty good price. What has Buffett been selling? Buffett has mostly been selling banks. Buffett does not like banks right here. He's been selling large positions in Bank of America. You add in the Capital One Bank and the Citibank and New Bank and all these other banks. That's around $14 billion in cash that he freed up out of these companies. Buffett has a lot of concerns about banks here. He's looking at the financial statements and seeing things that don't quite add up. And he may be concerned about losses on the portfolios of the banks in commercial real estate and their bond portfolios as well. What we have noted is that Buffett has not been selling additional Apple shares. Apple continues to be a large holding of Berkshire Hathaway. It was over 50% of the portfolio. Now it's a little bit over 20% of the portfolio, I think around 28% of the portfolio. and Warren Buffett seems to be happy with that percentage currently. Buffett does not like banks. There's a lot of companies that he does like, but there's not that many that he's picking up right here. And so it looks like the cash exposure is running around 340 billion to 350 billion, which is about a third of the total valuation of Berkshire Hathaway and over half of the securities that Buffett holds in Berkshire Hathaway. So when we look at this, we can see that Buffett is a little bit bearish here. He's probably more bearish than he's been anytime since the early 2000s and the 70s. And so we may want to watch out. If Buffett is wanting to free up cash and looking for a time to buy things cheaper, we may also want to be freeing up cash, adding to our treasury bond exposure or treasury bill exposure to get that interest while we're waiting, and see if we can find some good values further down the line. Since you love these videos so much, please feel free to subscribe to the channel, share with your friends, put those thumbs up. We got another video that you can watch right here. Stay tuned for more videos as they come out. Stay thirsty for knowledge. We'll catch up with you next time.